Welcome to Fair Lending Training for Board Members. My name is Tori Haggerty, and I'm going to be walking you through some key points that I feel that you could know to better do your job as a board member at your organization. A little bit about me: I started my career as an FDIC examiner, and I worked as a compliance officer and internal auditor for a few different organizations before starting my own business, now as an external auditor and trainer. I've been parts of hundreds of exams and audits over my career, so I've seen a lot of great ways of doing things. I've seen some not so great ways of doing things, and I want to share some of that experience with you here today. I've also authored the nation's first ever commercially available fair lending school. Here's our manual right here, and I've also written a best-selling book on fair lending. I want to cover some of the key risk areas that I normally teach to lenders, compliance officers, and auditors, but the key areas that I feel every board member should know. So what I want you to take away from this is understand the fair lending laws and the prohibited basis. I want you to learn a little bit more about the regulatory process so you can understand how examiners do examinations of your organization. I want to give you a basic understanding of the loan life cycle of fair lending risks, and then cover your role as a board member in overseeing fair lending. So I love starting off every fair lending training session with a quiz question. We're going to do that here. True or false? It is legal to discriminate against a loan applicant. Think about that for just a moment, and we'll come back to it. There's a couple different laws that I want to cover. And in fact, there's four main ones that I want to cover. The first two laws really kind of set the table for fair lending. It's the Equal Credit Opportunity Act and the Fair Housing Act. Now, ECOA, Equal Credit Opportunity Act, covers every loan type: commercial loans, ag-based loans, consumer loans, obviously. Every loan type falls under the Equal Credit Opportunity Act. The Fair Housing Act, on the other hand, as the name implies, covers home loans. And they have what are called prohibited basis. These are characteristics that you cannot base your loan decisions on. And they cover things like race, color, religion, sex, and national origin. And you'll see on your screen for the Equal Credit Opportunity Act and the Fair Housing Act, the first five are the same. The Equal Credit Opportunity Act goes on to cover things like age and marital status, public assistance income, and filing for protection under the Act, which is essentially a whistleblower provision. On the other side, for fair housing, they also have familial status and handicap. So my quiz question: can you legally discriminate against a loan applicant? The answer is true. Loan to value, a debt to income ratio, or somebody's repayment ability, or a credit score are all legal forms of discrimination. The illegal forms of discrimination are the prohibited basis characteristics in which we talked about under the Equal Credit Opportunity and the Fair Housing Act. So it is legal to discriminate on underwriting characteristics, not on prohibited basis characteristics. The third law I want to cover is the Home Mortgage Disclosure Act, or more commonly in the compliance field, we call it HMDA. Not all organizations are HMDA reporters. You have to have a branch in a metro area. You have to originate so many loans each year. You have to have a certain asset size. But for those of you that are, and most organizations are, you're required to collect data on most home secured applications. Notice I said applications, not originations. Yes, you're going to collect data on the loans that you originate, but also those that were maybe approved but not accepted, maybe withdrawn by the borrower, and most importantly, those that were denied. This HMDA data is key to fair lending reviews, both by the regulators to external auditors like my company, and internally, as your compliance and audit staff should also be reviewing HMDA data. Now, the data must be recorded and reported accurately. And I'll be honest, gathering HMDA data and scrubbing all that data and reporting it accurately is a huge burden on pretty much every organization, but it's key that that data is accurate, because then it's aggregated and analyzed for many different fair lending risks that we're going to cover in this short video. The fourth and last law I want to talk about is the Community Reinvestment Act, or CRA. Now, this covers virtually all banks under federal law, but other companies like credit unions and mortgage companies may also be covered under certain state laws. The focus is on lending to borrowers of different income levels, small farms and businesses, and low and moderate income areas. So fair lending laws really focus on the demographics, lending to minority peoples, high minority areas. CRA focuses more on low and moderate income people, and low and moderate income areas. Now, there is some crossover, there can be in that, but it's two different things. So why is the CRA so important? Well, there is some tests that are similar to fair lending, but the big thing is ratings are public. Now, your safety and soundness ratings, your compliance ratings, your Bank Secrecy Act ratings, IT, all of that is highly confidential. CRA is not. If I know your charter city and your primary regulator, I can go straight to the website and review your performance evaluation. And there is a section in there that talks about fair lending issues. If you have major fair lending issues, those will go in your performance evaluation and be made public. Now, let me give you some regulatory examination insights. So compliance examiners conduct periodic fair lending reviews, virtually at every compliance examination, whether you know it or not. Now, they review your program as a whole to find potential higher risk areas. Then they'll risk focus their reviews on those higher risk areas. So here are some examples. Let's say you work in or operate in major metro areas with high minority populations. They're probably going to do a redlining review. Let's say you have minimal pricing guidance. Maybe you don't even have basic rate sheets to guide your lenders on how to price loans. They're probably going to do a pricing review. Maybe you have high denial rates that they identified in your HMDA data. They may do a file analysis. The point is the risk is specific to each institution, and it can change depending on where you operate. So you may operate in the same area as another bank or another credit union or mortgage company that you're familiar with, but they may have completely different risks than you do. Let's now shift to the loan life cycle of fair lending risk. So this graphic on your screen is the graphic that we built for both our fair lending school and the book that we use this graphic for. It brings you through the full loan life cycle, and we will talk about all the risks along the way. From the moment your lenders take an application, they steer customers into certain products, and then somebody has to underwrite the loan. Then there's pricing risk for those that get approved. You also have policy exceptions because not every time lenders are following guidance. There's also denials and marketing, and then redlining, you will notice, is in the center of the graphic. In other words, any and all of these risks that we're going to cover can lead to redlining risk. Let's talk about risk number one. Application risk. You should have basic procedures that make sense for the size and complexity of your organization. You want to make sure lenders and upfront customer-facing staff know the proper way to receive or take an application. You also want to ensure your lenders are not screening or discouraging applications. Screening is when a lender will collect informal underwriting factors and communicate informal underwriting decisions. So let me give you an example. Let's say I come into your organization and say, I'd like to apply for a home loan or a car loan. And then I mention casually to the lender, you know, my credit's not that great. I think the last time I checked it, it was at 490, and that's a low credit score. And let's say the minimum credit score for your organization for whatever product I'm applying for is 620. I am so far below your organization's standards that your lender knows there's probably no way I'm ever going to get approved for a loan. In those cases, lenders often say, Tori, I'm sorry, you're just not going to meet our credit standards. There's no point of applying. Well, why is that a problem? It's a problem because they now have screened me and discouraged me from filling out an application. The Equal Credit Opportunity Act has a key word. It's opportunity. Everybody must get the same opportunity to both apply for and go through the underwriting process. How could I, as an external reviewer, ever know if your lenders are screening? I simply look at the number of denials. In that case, that lender is likely not going to have me fill out an application, and I will not get a denial, and that will not show up in your statistics. It's key that everybody go through the underwriting process and the application process each time. Risk number two, steering risk. So once you take the application, you have to figure out what product that you're going to place your customers in. Steering is getting customers into those products, and it's a good thing when it's based on the best interest of the borrower. Illegal steering centers on whether customers were steered on a prohibited basis characteristic. Now, most organizations offer industry standard products, things like traditional financing on home loans, car loans, boat loans, and these products reduce steering. But here are some products and concepts that increase steering risk. The first one, which a lot of organizations offer, is government guaranteed loans. Now, don't get me wrong. Government guaranteed loans can be a positive. They can get borrowers into a product that they would otherwise not qualify for. But government guaranteed loans carry higher fees to get into those products. Therefore, they're higher risk for steering. Add-on products like credit life or credit disability or maybe gap insurance. These can also be a positive, but when lenders steer minority borrowers into add-on products, it becomes higher steering risk. Or simply varying product options that serve the same purpose. They're similar products, but maybe they differ greatly on rates, fees, or terms. I like to use my 3-product example when I talk about steering loan products A, B, and C. Loan product A, this is your best product. It's your lowest rates and fees, longest terms. It's your prime borrowers. Loan product B, that's kind of our middle of the road. Probably most people qualify for B. Rates and fees are a little higher, terms are a little bit shorter. And then over here we have loan product C. This is our lowest quality product. I know we don't use the term subprime as an industry anymore, but that's what we're talking about. If lenders are steering male and white borrowers into loan product A, your best product, and then steering minority or female borrowers into loan product C, you can see where that steering risk comes into play. And steering risk crosses over with redlining when you do it geographically. In other words, loan product A is always getting solicited to maybe a higher income or majority white neighborhood, where loan product C is getting steered to your high minority neighborhoods. Let's go to risk number 3, underwriting risk. Now we've taken the app, we've steered our customers into a product. Now somebody has to make the loan decision. The underwriting guidance that you give to your loan staff should be clear, concise, and free from guesswork. And these are key points that I want you to take away from this. So this includes any written policies and any procedures that you have. So here are some examples that I've seen over my career of poor underwriting guidance. One time I saw no recent late payments. Okay, what does that mean? What's recent? 3 months, 6 months, 12 months, 24 months? Do I only have to care about recent late payments with my organization? Or do I have to care about other organizations? You see where we're picking that apart, and every lender is going to interpret their own definition of recent late payments. I also saw a luxury car. What's a luxury car? If you ask my daughter what a luxury car is, she feels a new Honda Accord qualifies. Now, I'm not dissing Hondas. I love Hondas. I've owned 4. In my opinion, it's not a luxury car. So every lender is going to choose their own definition. I also saw a classic car. What does that mean? In the state where I live, a classic car is defined as one 25 years old or greater. That is specific. Let's talk about the big one, good customer. Too often I see good customer used as a reason to make a loan decision or a reason to override policy. What the heck does good customer mean? Does it mean no recent late payments? If so, how recent? Does it mean you also have a deposit account with us? Does that require a certain balance? Does it mean you've been a customer of ours for 1 or 5 or 10 or 20 years? That you have loan accounts with us? That maybe you have no derogatories on your credit bureau report? When a lender uses good customer as a loan decision, it's a major red flag because it means nothing. Therefore, it means everything. Therefore, it means nothing. Define your underwriting criteria clearly. As a board member, it's your job to maybe not be the writers and creators of policy, but you're certainly reviewing it and approving it at your organization. You should review that guidance given to the lenders, including checklists and how they calculate ratios. And if it's not perfectly clear to you how they should make loan decisions, you should question it because it's not clear to them. Let's move on to risk number 4, pricing risk. So now we've approved the loan. Now pricing includes obviously the interest rate, but it also could be fees and maybe loan term or how long we're going to give borrowers to pay back a loan. Just like underwriting, you should have clear and concise guidance to lenders on loan pricing that is free from guesswork. Ensure your loan staff are actually following guidance. Clear and concise guidance is one of the best ways to build strength in your fair lending program. But if it's never followed, it loses that effectiveness. So discretion or getting away from policy should be controlled and monitored, but more on that in a minute. Your organization should be testing this area. There are tools available to test pricing for different prohibited basis groups. We have some in our Fair Lending School. You can also purchase software available in the industry to help with that process. As allocators of resources, you want to make sure your organization is reviewing this major fair lending risk and ensure you are pricing fairly and consistently based on prudent underwriting characteristics and not on a prohibited basis. Risk number 5, policy exception risk. Policies and procedures first must be well written, clear, and free from guesswork. It's the best way to reduce risk at any organization. But guess what? Actually following policy consistently is just as critical. You can have the most beautiful underwriting or pricing policy or guidance imaginable, if you think such things are beautiful, and as a fair lending expert, I do. But every time a lender deviates from policy, fair lending increases by a little bit. And then they deviate again, and it's a little bit more and a little bit more until all of a sudden they're deviating all the time, and they're essentially writing their own policy. So what types of exceptions are allowed at your organization? You're going to want to know that. Can they make pricing exceptions? Does that include rate? Maybe waiving fees? How about changing the terms or underwriting characteristics like loan to value, a debt to income ratio, or a credit score? Or maybe both. Most organizations allow pricing and underwriting exceptions. All strong policy exception programs should have a formal approval process in place. In other words, lenders should not be allowed to make exceptions on their own. It should always get up-channeled to a small group of individuals highly trained in the lending area that approve those policy exceptions. All policy exceptions should also be tracked. Every time an exception is made, that should be written down on a log, and then a strong program does periodic monitoring of the exception process and an analysis of those exceptions. So what does a good exception monitoring program look like? Well, first of all, what percentage of your loans have exceptions? If you do 1,000 loans in a year and have 200 exceptions, that's a 20% exception rate. Now you may be asking yourself, is that good or bad? Well, that's not for me to decide. That's based on your risk tolerance as an organization. It's a little bit high in my opinion. However, I've seen organizations go higher than that. Now, the higher your exception rate is, the more risk you're going to take on. So we'll talk about that here in a second. All exception reports should go to the board. In other words, you should see that analysis and what they're doing so that you can monitor and determine if those rates are acceptable. High exception rates not only increase fair lending risk, but also safety and soundness risk. Every time a lender goes outside of policy, fair lending risk goes up because now they're not making decisions consistently. Safety and soundness, or the quality of that credit, also increases because every time a lender goes outside of policy, they are taking on more risk than you have approved in policy. Let's talk about risk number 6. This is denial risk. Obviously, not every application is going to end in an approval. Strong and consistent underwriting greatly reduce this risk. I know I'm starting to sound like a broken record. If you have clear and concise policies and procedures consistently followed, you can almost eliminate your denial risk because they are following legal forms of discrimination, aka your underwriting guidelines, every single time. The strongest programs have some secondary review process of denials. Now, it should include a technical review because there are a lot of technical requirements on a denial, or in other words, it's called an adverse action notice, but it can also include a review of the credit decision and the denial reasons. In other words, you want to make sure that your lenders are following policy, and you can verify that either having a second qualified lender review that denial, or oftentimes a member of the compliance or audit department will also review those. Denial rates to the different prohibited basis groups can be monitored. Now, the easiest way to do that is with HMDA data because you already have it available. But you must either invest in software or pay somebody to review it for you. Now, if you are a HMDA reporter and you have significant data, you definitely want to have that done. Non-HMDA reporters or non-HMDA reportable loans, now we're getting outside of home mortgage loans, will have more work to do because you will actually have to collect some of that data yourself, but it's still possible. And a lot of that we teach in our school as well. If you see higher denial rates to certain prohibited basis groups, you should start asking questions. Higher denial rates when compared to peer lenders under HMDA is also heightened risk. That's the first time I've used that, peer lender. What does that mean? Peer lenders are other lenders in your area that also make home mortgage loans, and they can include other banks, other credit unions, or mortgage companies. Now, the regulators typically use the 50 to 200 range. In other words, if a lender makes more than double the amount of loans that you do, or less than half, a lot of times they're not included as a peer lender. If you normally make 1,000 loans a year, they're not going to have somebody with 10,000 loans in a year. They don't have the same resources as you do. When your denial rates are 2 and 3 and 4 times above peer denial rates, that's major risk. And you should know that, and that should be reported to the board. Let's talk about risk number 7, marketing risk. Now I get it. This is really where fair lending starts. When I drive to your organization, maybe I hear your ad on the radio, maybe I see a billboard, maybe I've been to your website or seen a TV commercial. You want to know what messages are you sending to customers. Most smaller organizations and even some larger ones focus on brand imaging. What brand are you trying to portray to the industry? Maybe we're your premier home loan lender or your commercial lender. Maybe we're your hometown bank or credit union. Brand imaging is the lowest risk when it comes to marketing risk. More aggressive institutions will talk about products, maybe some specifics, and maybe mention interest rates. Your marketing should be reflective of your population. So let's do another quick quiz question. If 30% of the population in the areas that you operate in are minority borrowers, what percentage of the people represented in marketing materials and on your website do you feel should be minority individuals? 25%, 32%, all acceptable answers. If 30% of your area is minority individuals and 3% of all the people represented in your ads are minority individuals, that's a 10-to-1 lagging indicator. That doesn't add up. I want to talk real quickly about the importance of a social media policy. I believe every organization should have a social media policy that sets expectations of what is acceptable and unacceptable. Now, I'm not talking about just being at work and getting on social media. I'm talking about what all employees, not just lenders, put on their personal social media pages. Too many times have I seen a news story of any random employee of a lending organization making very discriminatory comments on their own personal page. You want to ensure that all employees read your social media policy and know what is acceptable and what is unacceptable, and attest to it at least annually. Every time I do a fair lending audit, and I've done over 100, I do a fair lending interview with a lender. And one of the questions I ask is, do you have a social media policy? Obviously, I know they do. I've read it prior to the meeting. And most of the time, yeah, we do. Okay, great. When was the last time you read it? Well, I don't know. I started 9 years ago, so 9 years. Do you think that those individuals are going to remember the guidance in that policy? Once during onboarding is not enough. I recommend that all organizations read and attest to it annually. All right, let's get inside our loan lifecycle circle. Now we're on redlining risk. Everything in that circle can lead to redlining risk. What is redlining? Well, let me give you the DOJ, the Department of Justice's official definition. Redlining is a process by which lenders deny services to individuals in a neighborhood because of the race or national origin of the people who live in those communities. Notice I didn't specify, or they don't specify, home mortgage lending. Yes, redlining is often found in home loans. However, redlining can be present in any loan product. In fact, I have bank clients that are major commercial lenders that do very little lending for home loans, yet we still do a redlining review of their commercial lending. Even if you are primarily a commercial or an ag lender or just a consumer lender and not home loans, you still have a risk in redlining. It is most often cited in residential, and usually it's oftentimes based on your HMDA data. That means if you are a HMDA reporter, you already have all the data available to review your performance. In 2021, the DOJ launched their Combating Redlining Initiative, and since then there have been an unprecedented number of redlining cases that have settled. Here are some common themes in nearly every major redlining case. Your physical locations, where your actual branches and offices are located. Are they in or do they avoid minority areas? As a board member, you should know where those branches are located and use that information in making strategic future decisions on new branches. How about not receiving applications from either minority individuals or high minority areas? And guess what? If you don't receive applications, you're not going to be making loans to minority borrowers in high minority areas. As an allocator of resources, you need to know where you are making loans. And for both applications and loan originations, you can test that and you can map that on a map overlaying high minority areas with your HMDA data and software. If your origination rates for home loans are multiple times behind peers, that's a major red flag that needs resources dedicated to it immediately. How about not devoting advertising or marketing resources to higher minority areas? Yes, it helps to have a branch in that area, but if you're not marketing and people don't know about you, they're not going to be patronizing your organization. How about not assigning mortgage lenders to serve those higher communities, higher minority communities? The DOJ has pointed out most times organizations don't even have a location in higher minority areas. But sometimes when they do, they're not dedicating any lenders to serve the members of those communities. In other words, you're not going to be taking applications. You should also work with community groups and key members of your communities to expand your organization's outreach. They already have relationships with the communities and the community members you're trying to reach. Building relationships with key community members, the DOJ has pointed out, is an excellent way to avoid redlining risk and to penetrate previously redlined communities. If you have redlining issues or any fair lending issues, the best thing you can do is to act and act now. Fair lending issues are like old milk. They don't get better with time. Here are some of your responsibilities as a board member. Help establish and approve policies and procedures that are clear, concise, and free from guesswork. When you allow lenders to make up their own policy because yours is unclear, you're going to have risk across the board. Establish a culture of compliance, and that includes adherence to policy. Those policy exceptions should be just that, the exception. If you see high exception rates, lenders either need to make fewer exceptions or you might need to rewrite policy to better reflect your intentions. Know what resources you're dedicating to your higher minority areas. That includes branches, personnel, and marketing and outreach efforts. Ensure some type of fair lending review is done at least annually and more frequent based on the size and complexity and risk of your organization. Some organizations do reviews quarterly, some even monthly. Just because you may be small or rural or both doesn't mean you don't have fair lending risk. Here's what we covered today. We talked about the fair lending laws. We listed all four in those prohibited basis characteristics. Remember, you can discriminate on underwriting characteristics. You cannot discriminate on prohibited basis characteristics. We talked about regulatory insight to fair lending examinations. We looked at the loan life cycle of fair lending risks and covered each one along the way. And then we ended up with your role as a board member. If you want to learn more about our popular Fair Lending School designed to teach your compliance and audit staff how to not only build a strong fair lending program, but how to audit it themselves, you can visit our website at tcuniversity.us. I hope you found this video informative, and thanks for watching.